because they have this idea and understanding that they need to, induce. They need to take out the buyers before they take out the sellers. They need to take out the sellers before they take out the buyers, take out the sellers. They try to overcomplicate the back and forth nature of the market instead of focusing, trying to go back to back to back to back like a monkey, trying to swing from branch to branch until one of the branches breaks and you just fall and die. Something that I've never seen like actual smart money teach. Fuck. Oh, Mr. Mentor. Where are we going? It's so hard to see. It's so hard to see. You're at home, you're in front of your computer, you're making the decisions for yourself. You think you have an edge, but you never even studied it. You're just sitting there, click, buy. Oh, it's at the low. We got to get up to our supply. Buy. Lose. I wonder what happened. Okay, off to work. And then you repeat that for years until you decide to actually learn or quit. And that's sadly the journey of most traders. I need you guys to do this. Quick disclaimer, these videos are meant for educational purposes only. Anything said or shown in any of these videos are personal opinion and my perspective. Trading carries a high level of risk, so anything done is your responsibility. Hey, how's it going, guys? Welcome back to MENTFX, and this is going to be a saucer right here. We're going to be talking about how you can specifically use the culmination of the last few videos I made. So over the last few months, I released a lot of videos talking about the bullishness on UJ and the bearishness on EU. You're probably really sick of hearing it, but that's a good thing. That means you're actually learning. If you're not sick of hearing it yet, then you better get back to watching those videos. Now, that said, within those videos, I also dropped plenty of gems regarding the way I trade, regarding how I manage, regarding the sessions during which I look to trade, and a understanding as to how I look to have targets, how I look to target those targets, and then how I look to get involved as a result. So with that in mind, today we're going to be looking over some of the price action that has played out because the market is closed right now. It's also 9/17, so that's September 17th. So this video is going to come out a little bit later because I have to release one in the pipeline. But today we're going to look at exactly how you can take the most important teachings of the most recent videos and put them into real practical terms to begin to learn to see how the market delivers and getting used to it within the realm of the 3-box system. So to start with, to keep it very simple, the 3-box system is nothing more than recognizing an impulse in the market, taking that impulse and finding the supply and demand zone that created that move, and then allowing yourself to confirm that with the 3rd box, which in our book is Wyckoff, and look to continue that higher with management to overall take out this high and then hopefully continue milking significantly higher. So as per the 3-box system, the first box acts as just your impulse, and what this impulse puts in motion. So I think I used to do this, it's red, green, yellow or something, right? What was the... I think it was red, yellow, green, something like that. You know what? Doesn't matter. We'll just go with red. So what this means is once you have an impulse, you have a very clear way of identifying and recognizing where your protected low of an overall range is. So this is your protected low of the range, and absorption is permitted. So a lot of you will know about this concept of absorption. All that means is that price is allowed to wick down through it and catapult back up. What that's showing you is that on behalf of smart money or the composite man at these areas, because there is such high demand, even though it might come right through the zone, there is such quick buy-ups of that zone that it ends up being a wick on that given time frame. So if this is a wick and this is what occurs, then what you know is this protected low is still protected by way of huge orders funneling into the market at that point. So sometimes it's enough for smart money or for the composite operator to just mitigate most of his positions here and pick up new ones to keep going higher. However, in some cases, it can come right through here to pick up the liquidity that rests below here as well, and to filter out some of the more aggressive traders or some of the traders that are more emotionally inept or scared, fear, all that fun stuff, but also to trigger in a number of people that are looking just to sell stop this or to sell it down, right? That's always been the workings of the market. I've taught this forever on my channel, so make sure you understand that. And then there's a huge buy up of that low and the continuation higher. So you'll notice that, this kind of thing can happen a lot more during news as well. Like we predicted this move right here. I believe this was FOMC or NFP at some point. and price wicked like really hard into this, whipped out a few of the lower time frame ranges, also just absorbed them. I mean, it didn't even come over the top, so it's not even a good example of an absorption, but instantly came crashing down. And basically what I'm getting at is that if this wick extended beyond here, these are still optimal areas to look for those trades, especially if there's enough time for the candle to still close. So like if this is a 4-hour chart, right? So there's a 4-hour high and a 4-hour low. As price comes up through here, and if it's having a wick here, and you see on the right hand side right here that the candle still has, let's say, 3 hours or 2 hours to complete, you know that this wick, that this price action that might be a body during this point, can easily snap back. So if you start to see a weak to strong hand transfer on behalf of smart money and a distribution, you can look to get involved here on the basis of liquidation or on the basis of understanding there's an absorption occurring here. You know, in some cases you'll be wrong and it'll continue going. Maybe it won't even give you a confirm. Sometimes it'll end up closing up here on that 4-hour. And then that's it. Maybe you're in a position at that point and you can just manage it and you can just take it down. If you're not and it closes above, you can look at that as a break on this time frame and maybe walk away from it or wait for the next move down. So just as I told you guys in the last video, if you're an overall bearish market, instead of letting this break here act as a bullish area that you can now buy, you can now allow a lower time frame to act as a breakdown to start reselling, or wait for the 4-hour to re-break back down below its own low to then continue the move down, and thereby making what people think would be an accumulation into a distribution and all the fun stuff I spoke about in the last video. So at the same time, so now that we have this established, we know that this would be the protected low of the actual move that can be absorbed, just like we're looking at here. And the top of this move is going to be the target, or as we like to call it, liquidity, also continuation, right? Because again, we're not here just sitting here to take the final partial here and get off, because our point and our understanding of the market is that when smart money or the composite operator steps into a market, so let's say they step in here and it comes down, maybe it doesn't get to your zone, all good, breaks up, comes down, doesn't get to your zone, right? Maybe plays around for a while, makes some intermediary structure, but we're working left to right, right? So another left to right rule, figure out where you are, remember where you are. Don't get confused by this intermediary stuff. That's going to stop out a lot of retail and dumb money. Doesn't get to your zone, just misses it, comes back up, breaks, comes from this low to the new high, finally comes in, because on all time frames this occurs, and you're going to see this if you study the markets, just like I taught you in the last video. This was one of the, I gave you guys 4 things that you should focus on. And in the last video, I think this was number 2 or number 3. I believe it was number 3, where you test your system so you can gain experience around it. And you're going to notice this happens all the time. Smart money gives you an opportunity, or the composite operator gives you an opportunity, or other people that are smart and understand what's going on here to get involved. And upon that involvement, the move is already preset. The move is showing you what it wants to do, right? This is exactly what I've been talking about on EU for the longest time. The move is already showing you what it wants to do for a long time. And if you're aware of what it's showing you that it wants to do, you understand how you can use lower time frames to begin to get involved on all of this movement and catch it down. So with that in mind, right, you're going to eventually get a move here. Again, this is the protected low, just like taught here, right? This would be the red box. That's the impulse. You have the target high right here. And as price goes, that's the liquidation of it. And as you guys saw in UJ, as I've spoken about over the last 6 months on this channel, that can result in huge moves, because what's happened is smart money has shown their hands, smart money has gotten position, the composite operator is positioned, the smart money behind the understanding of what's going on here are position 2 now, and at this point it's a game of let's liquidate every single person that wants to keep calling highs. That's looking very far left to find support resistance areas and trying to trade all those or catch highs. Liquidate the people that do not use stops or try not to use stops and want to keep selling a market to try and cost basis average themselves back into profit. And then you get these huge runs. That's exactly how I got this insane runner right here, which also was spoken about way before it occurred on this channel as well as in the mentorship. And we broke this down completely from the beginning, from when this first broke here. And we just followed that through. And this was my first 202 RR of the entire year. So I'm really happy about that, right? So number 1 is understanding that you have the red box, which creates a protected low, and the target of liquidity that then also acts as full-on continuation due to what I taught you guys here. Once smart money is shown their hand, once smart money is positioned, once the composite operator is positioned, that move can explode, right? You don't know when it's going to explode. You don't always know if it's going to explode. But catalysts come in, news catalysts come in, just like I teach you guys in my Instagram. So what I'm going to do is I'm going to go ahead and show you what I mean by that. We'll go like this very quickly. Bear with me. Here we go. Right. So just to showcase this, I forgot which one it is. I'm pretty sure it's this one. Let's see. Oh no, what have I done? Okay, I'm pretty sure it's this one. That is not it. Well, that's a good one too. Okay, let's go again. Okay, I think it's right here. Nope, it's not. Oh my god. We're just gonna be going through my entire Instagram now until we find this. Jeez. Oh, I think this is it. This is it. Okay, cool. Also, check these out. There's a lot of good stuff in them. So this is basically the entire movement of the market and how the market moves. It moves under a formula of structure S&D confirm. Doesn't always reach its S&D, but we have multiple things that we teach concerning that and how you can work with that, especially work with it fractally. And in the mentorship, I offer you guys the ICI entry criteria or methodology, or even the triple M that allows you to not need always a pullback. But nonetheless, you have markets that are moving, markets then give you the 3-box systems in certain areas, off of this left to right rule of understanding where you are in a range and then what new range is set up. And as a result, markups begin to happen. And then you might have a news release or a fuel or an interest rate or an FOMC pump or whatever it might be that allows that move to, you know, skyrocket. That's kind of exactly what happened with UJ, right? As a lot of you know, I've made tons of videos on this now, but we started being bullish right here during this point here, started its mark up, broke up again. We started being bullish here, got in, started going up. We spoke about the 4-hour plays off of here. There was a 4-hour beautiful range. We spoke about this all in the mentorship. Mentorship students know exactly what I'm talking about. Played this up, and then as it began to break the 3-box high, at that point, the market started to mark up on some small news releases, and then around here, or like around here and here, there were huge releases concerning the actual interest rates, right? So actual, you know, big funds that are not ahead of the curve, or other banks or smaller funds that are not ahead of the curve, or other even retail that are not ahead of the curve, begin to invest and buy up sometimes big time here because they understand what this interest rate means, right? They might have their stops lower. Some people get stopped out here, all good. But on that catalyst, on that news catalyst, the move explodes and goes basically what we like to call parabolic. And since then has continued to do the same thing. We've been bullish, nonstop bullish, and it keeps delivering beautifully. We spoke about it going bullish last week as well. And there it goes. Nothing changes. And this is the exact way the market moves, right? There you go. You get your setups, you get the markups, you get news releases that fuel the move, and markets continue. That's literally the footprint of the entire market being shown to you. And those means by which you can enter, right, are, sorry, let's go like this. And those means by which you enter, oh my fucking gosh, I'm so bad at this. I'm like terrible. I should not be doing this on the computer. There we go. And the means by which we enter these are literally the 3-box systems, right? Here it is, the MENTFX 3-box accumulation. Now, again, some confirmations based on this point, are exclusive and taught only in the mentorship, which you can use if you want. The link is in the description. You'll learn everything you ever need to learn there. Again, not financial advice, all is perspective based. But you know, you can check out some of the testimonials on here to see what people think about it. But this is the footprint of the market, right? And these points will usually be also Wyckoff. Or you can do something very simple. If you come from a retail background, you can literally trade engulfing candle breakouts here, or very basic breakouts here. Because again, breakouts, boxes, triangles, all this stuff, it does work in specific situations or context of the market. If you don't have a context of the market and you're just trying to apply a pattern, you're not going to get anywhere. So, you know, you don't always have to apply my Wyckoff confirmation. But that said, when you have this impulse, within that impulse, you have the S&D that created that overall move. So we'll just make that gray. You have the S&D that created that move. And then as price comes back into it, you have the actual confirmation, which acts as any version of confirmation that you really want. But this is the overall 3-box system, and it presents itself. I think I had this on a lower time frame, right? Yeah, there we go. Much better. Yep. And this 3-box system will present itself at the start or on the second, third leg of a trend. This is something you got to get used to as well, something you should keep in your mind, because again, a lot of people like to wait for a shift and then hold on to this zone because it's unmitigated. Shift, they're still holding on to this zone. Shift, they're still holding on to this zone because they see it as unmitigated, or it has an imbalance here, so I need to wait. That's not the case. When ranges are invalidated, the imbalances that are associated with them are no longer important. In the future, if price does break down, sure, these can act as targets. These imbalance areas can act as targets, but it's not really important. You don't need it, because the targets of the next 3-box systems that's set up here are going to usually line up with other lows, come and get liquidated, fill in those inefficiencies, start to have mini mitigations off of the demand zones here that dumb money is watching, and as always, liquidate them, because those same zones that they're watching are also what we like to call as, basic psychological support that a retail trader might see. And a retail trader that's not aware that the market context is bearish is going to try to buy lows or catch a low of the market, and that's how they get stopped out. And that's exactly what's been happening here, right? Overall bearish market. Here you go. Support, people want to buy it. They want to buy it up. They want to keep buying 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 it up. That's exactly what you're getting here. And hopefully, as we've been following and are following without a new displacement above this high, this market's probably going to retain its push down, and I hope it does. It's going to be great. And we're going to keep catching them until it stops retaining that push. So to put it into practical terms, right, we're now aware that basically the entire market moves under this condition that once you understand what your target is, price doesn't always have to make its pullback to the S&D. It's likely to continue going. We can play that off the lower time frame, or we can get involved on that actual time frame if the price does give us a pullback, right? Because we're not here sitting and waiting. I mean, we can wait for the pullback, but we can also play it on a lower time frame. But what we're not doing is we're not waiting for a break like this, drawing out this point and looking to short down to it. Look in the short, down to it. Look in the short, down to it. Look in the short, down to it. Because that's exactly what a lot of dumb smart money does right now. That's exactly what your retail psychological mind is doing right now. That's exactly what most people that are emotionally charged are doing right now. And once again, community. And just to showcase this again, I mean, it's always a great representation. I don't use this to personally analyze, but I use it to teach. Notice that to this point, about 72% of traders are looking to short this still. And that number has been at like 85% back when we were around here. So this was all short on the retail side, or the dumb money side. Same thing with EU, right? You guys have remembered how bearish I've been for like 6 months now. If you're new to my channel and this is your first time watching me, sorry that it seems so complex and I'm speaking so fast. Watch some of my other videos. You're going to catch up to it, and you're going to understand it all with no issue once you get here again from the start. But we've been bearish on this for about 6 months, up to like almost a year now. Yeah, about 386 days. So just over a year, we've been very bearish on this. And nonetheless, this has, it's shifted over time. So you can see that right now, it's starting to shift the tides. But this number here was about, the long side was about 80%, 90% during this run down. So actually right now, as this begins to shift, if it does begin to displace upwards and starts to put in, the Dow double break, or the double MB as I like to teach it, to the top side, and the market does become bullish, you're going to see this right here shift, most likely than not, to that 42% on the short side being like 60% and 70, then 80. And when price is here, people are going to be 80% short, and you're going to be positioned off the 3 boxes that have presented themselves or keep presenting themselves, and you're going to be able to liquidate all of that capital. Once again, it's going to be the same thing back to back to back. The people that actually take the time to learn what we do here end up succeeding. Not financial advice. No, past results don't imply future consistency, whatever the fuck. But the people that don't learn and don't do the things that I talk about, the things I spoke about even in the last video, your 4 to 5 weeks of waiting to see what happens instead of having 8,000 trades, right? Again, check out the last video if you don't know what I'm talking about. The people that don't put in that work are the ones that are going to be on this wrong side, and most of the time they are. Or the people looking for that shortcut, or the people looking for the education that doesn't hold any merit. Okay, so that's something to keep in mind. Now, back to what we're talking about. Let me show you examples of how you can specifically trade this. So I'm going to actually just show you an example of my personal trade. So this was actually a long I took last week because of the context of the absorption. So this is not a trade that I should break down for you guys so you don't get too confused. I took 2 break-evens the week before that I could break down for you guys. I don't mind this one. This one might be okay. No, we're gonna skip this one. I want to show you guys something that's actually worked, so you guys can get used to it, used to seeing it. This one was a great one, right? And this trade right here, this trade right here showcased exactly what I want to teach you perfectly, actually. So I'm gonna break that down for you guys right now. So let me delete all this stuff so it doesn't get too confusing. If it lets me. All right, it doesn't look like it will, but that's fine. Okay, so go down like this. Let's go like this. Cool. All good. So back to this, right? Where did this trade come from and why did it come to fruition? And how did I follow this exact same model that I'm teaching you every single video and keeping simple for you? How was it followed, right? What did I do? So again, the model's simple. Keep your trading simple, right? Number one rule of the last video, keep it simple. And under that we have, and under that we have 3 steps. We have structure, we have SND, we have confirmation. And don't let anyone try to basically confuse or overcomplicate these 3 main things to you. Don't get into the idea of having to spot the inducement or spot the change of character, the flips, or the like there's just so many things out there right now that you can get confused with because of the way that people have gone with naming them. I don't have a problem. I'm just gonna make this. I'm gonna make the case here. I have no issue with people starting mentorships and teaching. I think it's an amazing thing that people that want to teach someone to trade can pass that knowledge on and give someone help. I think it's really important sometimes in actually any industry to surround yourself with people that are doing it, maybe then gain access to a lot of other people that are doing it or learning to see the mistakes that you might be making and start spotting things a lot quicker. However, you have people that continue to overcomplicate the process rather than simplify it for the viewer or for the listener, for the learner, right? And that's the only thing I have a thing against. So recognize that there's really 3 main components to the MENTFX methodology, as I'll call it here, to my smart money methodology, as we could put that in a little category of its own. This is the MENTFX methodology. So follow these 3 things. Don't ask me about change of characters, flips, inducement, all this shit that's completely worthless because it's all taken care of by this. If you understand what your structure is, how to judge breaks, and as a result where you are in a range and what your target and the protected high is, you're aware of what you're looking to liquidate. And if you're aware of that, you're aware of where your SNDs are and where your lower time frame structures and SNDs are. Because as I taught you in the last video, if you're aware and the market is screaming that it's bearish at you and you start getting bullish price action, if you wait for it to shift bearish, you're going to be on the correct side while a lot of others are going to be on the wrong side, right? So just to show you an example of that, here we go. There's actually multiple examples here, but a lot of people will see this break here and find their last SND zone. So they'll probably find this. That's a correct zone, by the way. I actually had the zone myself as well. And this. So they've done the first step correctly. They found the proper SNDs. Maybe I probably wouldn't use this. I probably only use this one. But a lot of people will find their 2 SNDs. And now this is where the issue begins to present itself. People want to start longing here on any break to get here or here before they look to go short because they have this idea and understanding that they need to, induce. They need to take out the buyers before they take out the sellers. They need to take out the sellers before they take out the buyers, take out the sellers. They try to overcomplicate the back and forth nature of the market instead of focusing on the direct target that you now have. And as a result of having that target, having a probability-based mindset around what price is most likely to do and then waiting for it to happen rather than trying to go back to back to back to back like a monkey, trying to swing from branch to branch until one of the branches breaks and you just fall and die. You don't want to do that. So instead, this is where a lot of people fall short. Instead of allowing themselves now to either wait for one of these zones and then trade the zone, they try to long into it. And that's where every basis of an issue comes from, right? When this broke down here, I also, just so you guys know, had this zone right here to go short from. Price never got there. Yet you can see I'm still getting positioned short. Why? Because I have an understanding from the contextual elements of this market that we are in a bearish market condition and going to continue bearish. And I'm also aware, as I teach you guys, that even in the 3-box system, so here's your red, here's your gray, here's your green if it got here. But off of just the red, we know that this will act as a protected high, right? And this low right here will act as liquidity or a target, right? And notice I didn't have to go and find equal lows to do that. All I had to do was recognize where I am in the trend and understand what my low for liquidity is. So at that same time, we're also aware, as I teach, that the 3-box system does not need to pull back here to keep going. Sometimes, actually most of the times it won't. However, when it does, you get the best kind of trades like we did right here, right? This gave you that pullback and continued through. All good. But that means you can play the lower time frame 3 boxes, right? So if you guys remember, I also made a video during this time where I looked at this and said, do not follow these intermediary breaks because they are fake structure. They are fluff structure. If you're on a time frame and you have a breakdown like this and it's showing you what range you're in because you're using the left to right mode of thinking, all you need to recognize, especially if the market's been showing you that it's doing a certain thing, you know, there's a different story if the market is like in a much larger consolidation in terms of, you know, breaks long, breaks long, breaks short, breaks short, breaks long, breaks long, breaks short. In this kind of situation, you can allow lower time frames and you can trade off more lower time frame zones. You can trade a buy here, you know, maybe you can try playing a sell here, then playing a sell here to predict the high, because, you know, it's not giving you a clear it's not giving you a clear bias, right? However, in a market that's clearly screaming at you what it wants to do, to look to long a market like this, especially if you're not profitable already, it's madness of the highest order. So when we had this break here, I spoke about in one of my videos that this is intermediary structure, and a lot of people, I even warned you guys, are going to start thinking that they should be longing in here, right? So smart money is looking to long, not smart money, but dumb smart money, as I like to call it. And again, it's not to insult anyone, but this is a lot of what the industry has become. A lot of smart money is looking at this demand zone here with the inefficiency, at this demand zone here with the inefficiency to go long. And you can see exactly how that resulted. And I even spoke about this. I told you guys it was going to probably come and take it out. I told you my targets were this low at the 200 RR. That's exactly what we had happen. And that's exactly what we came to liquidate. And again, this is recorded in all my videos. It's like I had 6 months of videos on this. Okay, I'm done trying to prove myself. I don't really need to prove myself, but I want to teach you guys. And the best way to learn is to see it happen, you know, kind of live. And I spoke about this happening live. So the dumb smart money side is looking at these demand zones to go long, right? And you would probably doing this too. I wouldn't be surprised. And then the retail side is looking at this break and retest to go long, looking at this support to go long, looking at this prior resistance turn support to go long, and this support to go long. So you can see how retail and dumb smart money stacks up if you don't have a proper understanding as to why you're laying out this higher to lower time frame approach. We don't do higher time frame to lower time frame so you can buy and sell every S&D. The reason we use higher time frame to lower time frame multi-time frame analysis for at least the smart money side here, because I teach a different stock system that doesn't require you to do that, but that's only for the mentorship, so I'm not going to even talk about that here. The reason we talk about it for the higher to lower time frame on FX or the smart money side is because when you understand your higher time frame and what it's telling you or screaming at you, as well as its history and where its target is, that's what keeps you out of using poor zones, bad Wyckoffs or bad springs, bad ranges, right? So now let's show you a real example, because I've been talking about showing you guys a real example, and I want to show you this, okay? So price breaks down, gives you a bearish break. Here's your high, here's your low, right? So how did I come up with that? Why is that the case? I teach this in the mentorship, but I'll break it down right now very quickly. You had a break of this low, right? It made this low, and very simply, all I'm looking for every time I find a high that created the break is to find the last up move before the down move in the situation of displacement. So I want to find the last displacement before the down move, which basically shows you the last liquidation before the move, right? So if you have a market, right, and let's say, you know, here's a low, and it's just playing around, whatever, just doing a bunch of stuff, right? Doing a bunch of stuff, and then breaks down. Where did this break come from, right? Where did this break come from? Where did that break come from? Well, when it broke that low, right, this is what a lot of people think is the high, but the reality is price played around, you know, mitigated whatever it did in here, intermediary, then it made this huge up move before it broke down. That right here is where the move came from. That's your protected high, because that's showing you where institutions stepped into the game to move the market aggressively. So very simply, right, where's the displacement? For me personally, that's a candle close above a previous high. It's how I've taught in the mentorship. I haven't really spoken about this rule on YouTube yet, but whatever. You know, you guys can use it. There's many ways to look at structure. You can use wicks. You can use, you know, just swings. Swings is a fine way to do it too. I personally choose to use this because it shows me displacement and it shows me the liquidation before the move. And as a lot of you people in the private mentorship know, you know, you guys can see the MBs here. You have the main MB here and the mini MB here. For anyone that, you know, that isn't in my private, if you're able to figure out how to use MBs and what they are and how we trade them in relation to me drawing these two boxes, then great, use it. MBs are a phenomenal tool, and if you want to learn more about them, it's in the private mentorship. Why don't I teach it on the public? Because there's a lot of depth to it. They're more than just one simple little concept, and I can't explain it in one video. I choose to use that fully for the private mentorship, and it creates a better symbiosis of, you know, community. When you're there, you have access to the exclusivity, you learn from it, and you push forward with the team. And that's what I've created. So that's just why I do it. So, if you're wondering why, don't let me know in the comments. Just be cognizant of the fact that I have things that I personally teach. I have time that I put into the stuff I put out. I put out value, at least in my mind. I hope you guys see it the same way. And some of it I keep exclusive for the community, and I teach them there. But nonetheless, you had the breakdown. The last up move before the down move, before the liquidation happened right here, right? Not here. So this high is no longer important. Basically, if this high broke, I'm looking for it to be a bullish on this market. I'm not looking for these like zones here. That's a lot of issues that other smart money have, right? They want to see price stop here. Maybe 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 they want to see price stop here at the refinement. Maybe they want to see price stop here, because look, all these areas are unmitigated areas, but none of these are important because they're not telling you a story behind what's occurring from a standpoint of how money is moving in this market on its most recent ranges. The only thing that's telling you that story is this break right here. And when that breaks down from a theory of left to right structure, right? So left to right, if you follow this, you have a low, and then all this is intermediary, none of it matters, and then breaks. When that breaks, it shows you the high, it shows you the low, it shows you the target, it shows you the protected high, and it shows you the S&D as a result of that. Now, a lot of people in the mentorship know that we could already start looking short here because of this MB. If you have an understanding of MBs, then you understand how that mitigation there works. Cross time frame, right? This is probably like, if we want to think about it, a weekly, a 3-week, or even a monthly zone, right? That's how we visualize this. But that said, when we get these breaks in here, they're intermediary. They're not important. They're fugaloo, right? Like from the Wolf of Wall Street. It's a fugaloo. It doesn't exist. It's just stuff that's there to entice the dumb-minded or the psychologically minded to start getting in, because it's creating highs, it's creating lows, it's creating some form of pattern that people want to take, whether it be on the retail support resistance side or the actual demand zone side. So back to the point that I'm trying to get. We have the breakdown, you have the high, you have the low, you have the protected high, you have the target, and now we either A, set an alert right here and walk away, or B, if we're day traders, we are aware of the context of this market, which is bearish, and we allow a lower time frame range to work as a short side play for us now. So as we step down a time frame, keep yourself aware about where you are contextually, right? This is something that I've never seen like actual smart money teach, because again, many people do analysis on their higher time frame and then switch down to lower and then start trading everything, right? They'll do their analysis. They'll say, okay, I have a high, I have a low, and then they'll say, all right, I'm going to sell this point, this point, this point, this point, this point, this point, and this point. And then price delivers to maybe one of them. No, it doesn't. Whatever. So it doesn't here, or like maybe to this, and they're like, yeah, I got it perfect. But it's like you have a striped pajama fallacy. You have a Where's Waldo lines. You're just striped pajama everywhere. You have no idea about what you're actually looking for, right? So the important thing that you need to do as well, something to kind of uplift your own thinking, is always, every time you switch a time frame or every time you come on every day before a session, ask yourself where you are in the markets, right? I can be blindfolded right now. Ready? Watch this. Hopefully I have my mic. Here we go. I'll move my mic with me, okay? Without looking at the euro US dollar right now, okay? This is what I'm aware of, okay? Let's see. What am I aware of? I know the weekly has been bearish and has broken down bearish structurally at least, I believe, 3, 4, or 5 times, and it's still holding bearish. At the same time, the daily has continued to deliver bearish, has delivered bearishly for, an endless amounts of breakdowns, probably around 6 to 10, I would say. But either way, all we need to be aware of is where we are right now. And right now, we're in a weekly bearish range, looking to go lower. We're in a daily bearish range, still looking to go lower. The 4 hour is still breaking down bearish, or at least currently in this moment, it's already broken down here, but it was bullish. So before my actual trade, I'm aware of where I am in this market, right? This is something that you need to do for yourself. So at this point, what I was aware of was that we started to break upwards on the 4 hour, and that we're actually now in a bullish 4 hour, I'm just going to come back here because this is stupid, but you guys understand what I'm trying to say, because we're in a bullish 4 hour situation right now. So I'm aware that even though it's bullish, I don't need to be a buyer. Okay, this is the point of doing higher time frame to lower time frame. When you go to higher to lower and you create a context about where you are, why are you then looking to buy this or buy this or buy this or buy this? Right? Then you shouldn't be even going higher to lower. Just stick to one time frame and trade every zone you see. There's no point of doing a higher to lower if your understanding of higher to lower in terms of where your targets are isn't going to actually alter or keep you out of other trades and ranges, right? That's why you do this higher to lower approach. So if you're aware that you're in this 3 box, you know that this is your target. Price doesn't have to get here, but you're where you're short. You come into the week, the 4 hour breaks down, okay? That's when the 4 hour broke down. So at that point, the 4 hour has now shifted bearish, right? And the daily is bearish and the weekly is bearish, right? So I'm aware at all times where price was at this point. And then once again, something that I teach you guys. So this is going to be the last bit of sauce before we go crazy here. We have this breakdown. Same thing as we just explained on the daily, okay? Same thing. Price didn't make it to its daily zone and it started breaking down on a lower time frame. Now look what's happening on the 4 hour. Price broke down on the 4 hour, didn't make its way up to the supply zone here or here. Didn't hit either one. However, it still went short. So again, a lot of people are already beginning to long in here, right? Any first break they see, this is what a lot of smart money does. They go like this and they go, okay, break. Okay, I got a long here to get up here. Okay. Break. Okay, I got a long here. I'm waiting. Oh, break. Okay, I got a long here to get up here. Oh, break. I got a long here to get up here. Oh, fuck, it's failing. Okay, fuck. Oh, shit. Okay, I caught it. Oh my God, it's going. Oh, fuck. Oh, wait, I caught it. It's going. And they get liquidated. And they're stuck in this mentality of, I gotta get here. But why? The market's not there to always have to pull back to just the zone you drew onto your chart. It doesn't make any sense, especially if the money is moving the market short. What makes you think that the fact that you drew your little trading view zone on there, that the price is going to magnetize to there. It's going to explode there. It has to. No. Wait for the move. Wait for a symbiosis between the timeframes. Wait for the higher to meet the lower, to meet the lower, to meet the lower, or for the higher to be in place, and wait for a lower that might be bullish right now to meet a bearish range, and then begin following that down, because you're aware that markets move like this, and when they break down, they might not give you the perfect entry, break down, then give you an entry, come down, break down, fuel comes in, off we go. And that's what happens. And sometimes this fuel doesn't always have to be news. This fuel can be as simple as the fact that we're in an overall previous significantly bigger daily range. And because we've already gotten positioned, or smart money has positioned and institutions have positioned, they're now going to be holding to actual targets, price can fall off the face of the earth. Because what is it? Like demand fully dries up. I think it's demand. Demand is fully dried up. And at that point, the only demand is people that are trying to buy all these zones here and trying to, catch a bottom. Liquidation. And then you get the huge moves down. And that's exactly what's been happening on UJ to the long side and on EU to the short side. Okay. So back to the basics, right? We are now, again, it looks like there's a lot of stuff going on here, but every time we switch down a time frame, ask yourself, what is going on? Right? Do not forget. So I could be right here right now, right? And based on what we just did, all the analysis we did, when you show up to the markets on this day, so let's see when this day begins. This day begins, for me, my session begins around 9 a.m. So this is where my session begins, right there at 9 a.m. Move this to the left because that was my trade. Right there at 9 a.m. My session usually ends around 11:30. Just depends. Usually 11:30 or so. So this is usually my session, okay? When I arrive here, I'm not looking at this going, okay, demand zone, support, resistance, oh, shit, oh, equal lows, guys. No, I'm not doing that. I'm saying, where am I? What's the story? What am I probably going to be looking for today? And again, I'm on the 5-minute chart here, but watch, this is what you need to do every day before you arrive. So let's say today is a real day. We just arrived on the charts just now. Boom, we're on the charts. We just got here. Am I looking at this going, where am I? What is this? It's going back and forth. It's up and down. Oh, fuck. Oh, Mr. Mentor. Where are we going? It's so hard to see. Oh, shit. Hold on. It's so hard to see where price wants to go. I don't know. How do you do this? It's bullish. Okay. There's no need to do that. Why? Because now you understand the principles that you need to come to the charts with. And the principle is, the weekly's been telling me it's bearish, and we're still bearish. The daily's been telling me we're bearish, and we're still bearish. And where's the daily low that we're bearish until? It's right here because I'm aware of that. I'm aware of where I am in the market at all times. I don't have to be on those timeframes to see it because I'm aware of the timeframes and how they work in tandem and what I'm waiting for. So I know the daily low is here. What's the 4 hour doing? I know that the 4 hour just broke down. The 4 hour supply zone is here. Price did not get to the supply zone, but it doesn't need to because of the understanding we have of the market. We know the daily target is still down here. The 4 hour low is here, and that's our target. So coming into the session, if we get a clear bearish range off of a bullish range, especially when liquidity comes in, which would be during a liquid session, and if you want to learn how to know what liquid session we're in, check out my session sauce video on YouTube. If I come in and see that, that's something I'm willing to take short. Okay, so now instead of looking at this and trying to puzzle where price is going, what the inducement level of all these lows is going to be, where the hidden sigma zone of the top G blokes is going to be hidden, with the inside range expansion, fucking Doolittle triangle formation, goblin blaster. Instead of trying to do that, I'm sitting here going, I know the overall story that price has been telling me, and it's been telling me that it wants to go short. And if I know that and see a clear short reason to go short, I have a huge space in which I can get short. From here until here is at least my first target, so I have a huge amount of space to work with there. And then from here until here is my second target, so I have a lot of space to work with there. And I'm aware I'm bearish overall in this market. And I know that I could do one of two things today. I could either set an alert at this supply and wait until it gets hit to go short, but be aware that price might not get there. Or if I'm a day trader or I want a trade, I can step down timeframes and allow a range to set up that's in motion with what I'm looking for. And very simply, that all that means is we're looking for a 3 box using the left to right rules of identifying structure so we can go short. Okay, so very simply, as I came in this day, I'm not going to break down the exact entry criteria because that's for the private mentorship, and I broke that down in that video. I believe that's webinar 65 and 66 and 64. All of them had insane breakdowns, and then you guys saw us follow it through and why we followed it through, how I held over the weekends, why I held over the weekends, and all the fun stuff, associated with that. Also, if you're doing well, let me know below. It means a lot to hear from you guys. So yeah, just let me know if you're doing well. And otherwise, if you're doing really well, you don't want to be in a community, all that fun stuff, you don't have to be. Check out the link above, check out mentfunding. But also, if you're very profitable and doing very well, it'd be an honor to have you as part of our community, to be a little bit helpful to maybe beginners, for people to chat with me, chat with some traders, and it's also at the end of the day, a free write-off for you on your taxes if you're trading full time and trading is your business, right? So yeah, it's a cool thing you can do. So there's your little sales pitch for the day. So we come into the market, and 9 a.m. for me is my session. It's euro US dollar. So euro and dollar we know is going to most likely be liquid during the European, and the dollar and the New York Times Europe, aka London, trades at around about 1 a.m. till 7 a.m. New York time, and New York time is around 9 a.m. until like 4 p.m. but really like 9 until 11. That's really when all the liquidity comes in. That's usually why you guys can see my general sessions are from 9 a.m. to 11:30. Sometimes I'll get up a little bit earlier, like 7 or 8. That just depends on if I'm sleepy or not, if I'm taking care of my child or not. And by the way, my daughter is finally here. I don't think I actually told you guys that. She was born on August 27th. So I'm very blessed and lucky to have her. We're very happy. Yeah, so there you guys go. That's happened. But anyway, right, when I look at this, there's no reason to get yourself all up in a panty bunch over it, because we're now aware of where we are. We know that we're coming into the market bearish. We know that if there are bullish ranges, we don't need to force them or focus on them based on the few videos I just showed you guys, especially the last one. Instead, because we're looking for that refined entry, we're just going to wait for a 3 box to set up for us on the downside. So already, if you're a 5-minute trader, right, price comes in, and again, you're going left to right. So price comes into your session, and you go left to right. You go, okay, I broke up here, continued breaking up. This high was put in by this liquidation, so that low. Price broke down, so now it's bearish. I could be bearish if I wanted to from here, and that could be your day. And now you could wait. If price comes up into here on the 5-minute, you have an optimal sell there that you can then look to take short, because the 3 box is in motion, right? You have box 1 giving you a target, giving you an area, and you can look to take it short. Or just like I just taught you guys on the 4 hour and the daily, we could step down timeframes and begin to trade these inner workings here to the short side, not to the long side. A lot of people, once again, want to come in and they will find any reason to go long. They'll be like, break a structure, even though it's intermediary, long, break a structure, long, break a structure, long. No, we don't do that. We don't play that game. We're not in the business of emotions, right? As I like to say in my mentorship, you are not a casino gambler, okay? Most people trading are just people. They're basically just gamblers in suits, right? It just feels more prestigious. You're at home, you're in front of your computer, you're making the decisions for yourself. You think you have an edge, but you never even studied it. You're just sitting there, click, buy. Oh, it's at the low. We got to get up to our supply. Buy. Lose. I wonder what happened. Okay, off to work. And then you repeat that for years until you decide to actually learn or quit. And that's sadly the journey of most traders. Most people lose, and that's exactly why they lose, right? You guys can see it. It's plastered on the walls. So once again, we're bearish. We're coming in bearish. Great. My session comes in. I'm usually on the 1 minute charts. Okay, let's see what happens. My session starts. Again, am I confused or worried about where I am? No. I ask myself, where am I? Let's figure it out, right? Left to right. Price made a high, price came from a low, price broke that low, came from this high, never gave me an entry here, but either way, I wasn't even on during that time, kept following it, right? Because I can mark this up quickly. Broke down, great. Did price get here? Nope. Broke down, look at that, doesn't even get to the low. Now we're waiting for a break of this low, or I can be a trader at potentially, really, I could have even been a trader here, or it looks like this is mitigated. So really right here, the unmitigated wick, right? Or you could have used the actual unmitigated zone, and that could have been your trade. I actually maybe missed that. Maybe I wasn't on during that time, but I kept following this. Price breaks a low again. Am I now worried about all these prior zones here? No, they all act as liquidity, as intermediary. They're not important. The only thing that's important is the 3 box at hand. And right now you have a breakdown, you have a zone that created that, and that's where I want to go short from, because that's what it's showing me, right? And am I confused? Am I dazed about all this weird price action that's moving back to back? No, because I've experienced my system. I've done it for hours, and it's all good. How long are we in this video? Oh my God, it's 40 minutes. All right, we gotta wrap this shit up. But back to the same thing. This is where I want to go short. Price pulls back, fails to get here, breaks again. Do I care about the zone anymore? Nope. We're following the price. Price breaks down again, because what are we aware of? When price starts, so it came up, here's a low, here's a high, here's the low, here's the high. It can break down, it can keep playing, not giving you any entry. Then it can give you the 3 box system entry based on what I teach you here, and break down with the fuel that can either be brought on by news, or the fuel that can be brought on by the fact that we have a 4-hour target here and the daily target here, because of the context of the trade being extremely bearish currently, okay? So price comes back up, I validate it, and I confirmed it right here with a double MB confirmation, which is shared in the private mentorship. If you want to know exactly how, or if you join the mentorship today, just ask me, but you should be able to find it in webinar 60 plus, I believe. Like, when was this trade? 18th of August. I can't jump into Discord right now because it has all the links on it, but maybe I'll leave it in the description below, or just ask me in the mentorship. I'll let you guys know. I'm always active in there, so I'm happy to let you know. Got involved there. Price began to break down. Already was broken even on it during, I believe, like this candle, because we were on a much lower time frame, using my trade management tactic that I teach you guys on my YouTube, so you'll see it there too. Begins to break down, get my first bar secured, and the rest is history, right? It comes in, it begins to put in the catalyst after its 3 box setup, and it's off, right? We start liquidating, and then, you know, the rest is literally just history, right? We start going, we hit the 4-hour low, we're just managing, we hold over, like, I think I held this over 2 weekends. The swap fees were positive, so that means that I was paid to hold the trade, because of the way the interest rates are right now for EU, which was great. I probably wouldn't have held this as long as I did if the swap fees were not as positive, but delivered down with, what do you see? Huge momentum coming into the market, right? And where did this momentum come from? Was it random? No, it could have been because of news, all your fun stuff, or it could be because the market is screaming at you that it's been bearish and is bearish, right? And that's exactly what price delivered the way it did. And that's exactly why in the last video, which will be uploaded by now, and, you know, price will have played out by now, I was talking to you guys about the importance of not forcing longs off of a bearish market and instead waiting. So like even here, we spoke about this long. People are going to try to go long here, right? People will want to go long, and it might work. But the reality is price is most likely going to come take them out and keep going short. That's exactly what I'm looking for. Come a little bit higher and come take them out. Come a little higher and come take them out. But you have your higher time frames in motion for that, right? So there's an entire synopsis of how you actually want to, number one, keep it simple. You follow a structure, S&D confirm, and you follow it across timeframes, and you allow the higher to the lower time frame analysis actually work together rather than against each other. Because a lot of people, instead of doing this between higher to lower time frame, do this. They look at the higher time frame, they analyze it, they have their analysis, then they look at the lower time frame, they have their analysis, and they'll just trade this. and this doesn't affect it. I need you guys to do this. There needs to be a merge between the two. That is how I teach you to think. And it's because if you're aware of what the higher is doing and you allow the lower to be, I guess it would be like this. If you allow the lower to be colored, right, or held together by the higher, that's when you can get these larger movements that are on your side rather than constantly against you. Because every time you're trying to force one of these lows as a new long, because on some time frame, the 1 minute, the 2 minute, the 3 minute, 5 minute, 15 minute, 30 minute, it broke up and made a bullish break, that's how you end up getting liquidated on repeat, or end up on the wrong side, or end up with the wrong zones. So that's something that you need to keep in mind. And if you're part of a community right now that's teaching you kind of to think this way, where you're trying to catch lows and you're just trying to catch any demand zone, or like, the biggest thing that they harp on is like, you need to catch this demand, you need to catch this demand, you need to catch this demand, you need to catch, any demand, like just any of these, like 4 hour break, that's a 4 hour break, you got to catch it, you got to catch this, you got to catch that. Without a context behind it, well, you're still playing a striped pajama game. So either distance yourself from that, unfollow some of the Instagram shit that you're following, especially if it's in the chart jerk off porn, and focus on keeping your system very simple. Because when you can keep your system simple with a few rules, you can go and actually test it and then learn from it, instead of having to think that the more concepts you learn, the more likely you are to be successful. It's not always the case, right? The more you get to experience, the more you're going to be successful. The more words you learn to describe a zone or to describe a BOS is not going to make you successful. It's not going to grow that understanding. So thank you guys for watching. My voice is dead, but I hope you guys enjoyed that. I hope you take a lot from it. I hope you understand how and why I was looking for shorts on this. Again, it's all documented on the YouTube, so I do suggest you check out some of my recent videos. And this video is going to show you how to basically merge and put together all the previous videos, and how important it is to actually let the higher not separate from the lower, but the higher to color the lower, because that right there, if you see my eye, is where our system comes from. Whoa, I see you. All right, bye.